Imagine for a second that it is New Year's Day, 2000. You have spent the last 2 decades working your tail off, finally hitting a major milestone, a clean $100,000 tucked away in a reliable S&P 500 index fund. Based on everything you have heard about the market's historical 10% annual climb, you are expecting that money to carry you comfortably into retirement. You've done the math in your head, assuming that even with a few bumps in the road, the power of compound interest will double or triple your nest egg while you focus on the final decade of your career. Now, fast forward 10 years to December 31st, 2009. After a decade of world-changing events, personal milestones, and hard work, you open your account statement expecting to see $250,000. Instead, you see $91,000. You didn't just fail to make money, you actually lost it. In nominal terms, you averaged a negative return over an entire decade of your life. But when you factor in the rising cost of living and inflation, your actual purchasing power has been slashed by over 20%. This isn't a scary campfire story designed to frighten children. It is recent history, a period we now call the lost decade. If your retirement plan assumes this can't happen again, or if you believe that the stock market is a guaranteed escalator to wealth, you are playing a dangerous game with your future self. Most financial advice found online today is built on what I call the up and to the right fallacy. The idea that if you just wait long enough, the S&P 500 will solve all your problems and erase all your mistakes. While it is true that over 30 or 40 years the market has historically trended upward, for someone who is 5 or 10 years away from retirement, long enough is a luxury you simply do not have. Understanding the mechanics of a flat or declining market is perhaps the best return on investment you can get on your time, because it represents the difference between retiring with total confidence and being forced back into the workforce at age 70. When we look closely at the numbers from 2000 to 2009, it wasn't just a boring flat line on a graph. It was a psychological and emotional roller coaster that broke the spirit of millions of investors. During that span, investors were hit by two of the most brutal bear markets in modern history, the popping of the dot-com bubble and the 2008 global financial crisis. You waited 7 long years just to get back to, even after the first crash, only to watch half of your money vanish again in just 18 months during the second. It felt like a jagged saw blade cutting both ways, and it proves beyond a shadow of a doubt that the market does not owe you a positive return over any specific window of time, no matter how much you feel you've earned it. The primary danger facing investors today is recency bias. If you only started your investing journey after the year 2010, you have experienced an absolute powerhouse market, one of the longest and strongest bull runs in history. And you probably think that making money in stocks is easy or inevitable. But the market has ghosts that haunt the history books, such as the Japanese Nikkei, which hit an all-time high in 1989 and took over 30 years just to recover its nominal value. Even in the United States, we have seen extended periods of stagnation, like the 16-year stretch from 1966 to 1982, where real returns after inflation were essentially zero. For a young person in their 20s, a lost decade is actually a hidden gift, because you are effectively buying shares on sale for 10 years while your income is rising. However, if you are 62 years old and planning to walk away from your job, a lost decade can be a financial execution due to a phenomenon known as sequence of returns risk. This risk dictates that the order in which you receive your returns matters just as much as the average. If you hit several negative years, right as you start withdrawing money for living expenses, you are forced to sell your shares when they are at their lowest point. This creates a death spiral for your portfolio, compounding your losses and potentially causing you to run out of money, even if the market eventually recovers years later. So, the question becomes, how do you build a portfolio that doesn't just sit there like a decorative rock during these lean years? The answer is the one thing people hate to hear when the S&P 500 is booming and tech stocks are reaching the moon. True diversification. During the S&P 500's lost decade, other areas of the market like emerging markets, global bonds, and small-cap value stocks actually performed quite well. Diversification is often called the only free lunch in finance, but it only tastes good when the main course of U.S. large-cap stocks is spoiled. To protect yourself, you need to look beyond the handful of U.S. tech giants that dominate the headlines and own a broader slice of the entire world's economy. Furthermore, you need to embrace the boring stuff that many modern investors have abandoned: bonds and cash equivalents. In the middle of a lost decade, bonds provide the essential stability that keeps you from panicking, but more importantly, they act as dry powder. This allows you to rebalance your portfolio by selling what is stable to buy stocks while they are in the gutter, which is the only way to manufacture a positive return when the market index itself is flat. Beyond your asset allocation, you must master the one lever you actually have total control over: your spending and withdrawal rate. Rigidly following the popular 4% rule, which suggests you can withdraw a fixed percentage of your starting balance every year, is a recipe for disaster during a market meltdown. Successful retirees who survived the lost decade did so by using flexible guardrails. This means having the discipline to cut back slightly on discretionary spending during down years and capping your spending during boom years to maintain a protective buffer. You have to be willing to adjust your lifestyle to the reality of the market, rather than trying to force the market to conform to your lifestyle. Ultimately, a lost decade is only lost if you stop participating in the market out of fear, or if you fail to prepare for the volatility in advance. The S&P 500 is a powerful tool for wealth creation, but it is not a magic wand, and it is not a savings account. By holding a global basket of stocks, maintaining a cushion of bonds, and staying flexible with your personal budget, you can ensure that you are the one looking back with a smile 10 years from now, while everyone else is wondering where their life savings went. You must realize that the high returns of the last decade have been pulled forward from the future, and the bill will eventually come due. When the momentum fades and the hype dies down, the investors who focused on risk management and diversification will be the only ones left standing. It is easy to be a genius in a bull market, but true financial independence is forged in the fires of a lost decade. Stay prepared, stay diversified, and stay optimized, because the history of the market is not a straight line, and your strategy shouldn't be either. Refusing to acknowledge the possibility of a stagnant market is not optimism. It is negligence. True optimism is building a plan that succeeds even when the market refuses to cooperate, ensuring that your retirement is defined by your choices, not by the fluctuations of an index. By widening your perspective to include the lessons of the 1970s, the 2000s, and the Japanese experience, you arm yourself with the context necessary to ignore the noise of the present and focus on the structural integrity of your long-term wealth. This is the path to a resilient future, one where you are the master of your finances regardless of which way the wind blows on Wall Street.